Welcome to The Explainer. Today, we are digging into a really thought-provoking thesis from real estate CEO Munawar Abadullah's annual letter. He basically argues that almost everything we've been taught about investing in property is fundamentally flawed. Let's get into it. So let's start here with his core idea. Abadullah claims that the biggest risk in real estate isn't the market, it isn't interest rates. It's just simple confusion about what you're actually doing. He thinks this one mistake is at the root of all the others. And honestly, it's an idea that might just change how you see property investing forever. All right, so what is this big confusion? Well, the entire thesis rests on what he calls the separation of church and state for real estate. The argument is that we use one word for two completely different concepts, and that's where all the trouble begins. Think about it. On one side, you have your home. That's your sanctuary. It's emotional. Its value is in safety, family, and your life. But then there's the investment. That's a business. It's cold, hard math. It's all about ROI. And here's the problem. We let the emotional feelings we have for the sanctuary bleed over and cloud our judgment when we're trying to make a purely mathematical investment decision. Okay, so if that's the core confusion, how does it actually play out in the real world? Let's deconstruct the way most people invest, because Abadullah says there are two huge hidden traps that people fall right into without even knowing it. And it all starts with something we take for granted, the 30-year mortgage. We just assume it's the right tool for the job. But he argues it's really just a historical accident. You know, it was created to help people buy a home to live in, not to be a sophisticated investment vehicle. And for an investor, it actually sets you up in a really, really lopsided partnership. And this chart says it all, doesn't it? It shows just how lopsided that partnership really is. Look who's at the top of the food chain. First, the bank gets its interest. That's guaranteed. Then the government gets its taxes, also guaranteed. And who's at the very bottom? You, the so-called owner. You take on all the risk, the tenants, the repairs, the vacancies, all for the little slice that's left over. If anything's left over, you are quite literally the last to get paid. So the financial structure is the first trap, but that's only half the story. The second trap is this idea, this myth, that real estate is passive income. And Abadullah does not pull any punches here. In a way that feels very much like a fiduciary giving you tough advice, he calls it the single greatest marketing lie in finance. He has this fantastic term for the reality of it: operational drag. It's that second job you never actually signed up for. It's the tenants, the toilets, the legal headaches. But it's also the bigger, invisible costs. You've got all your capital tied up in one asset, in one city. Talk about concentrated risk. And what happens if the market turns like it did in Dubai? You can't just sell 10% of your property. You are stuck. It's completely illiquid. So if the traditional model is a trap of bad debt and operational drag, what's the alternative? How have sophisticated institutional investors been doing it for decades? Well, it turns out they use a completely different structure. The solution is a concept called fractionalization. And it's pretty simple, really. Instead of buying the physical property yourself, you buy a share of a company, an LLC, that owns the property. This is a huge deal because that LLC acts as a legal firewall. It separates the investment from your personal life, so if something goes wrong, your own assets are protected. And when you put them side by side, the difference is just crystal clear. Direct ownership means high personal risk and the second job, all for one single asset. Fractional ownership gives you limited liability, zero operational headaches, and the ability to build a diversified portfolio. You're basically trading the ego of saying, I own that building, for the financial intelligence of owning a stable, diversified portfolio. Okay, so fractionalization solves the liability problem and it solves the operational drag problem. But there's still one big, stubborn issue that's always plagued real estate: liquidity. So let's look at how technology is now being used to upgrade this already smart model for the modern world. Now, as soon as you hear words like tokenization, I know what you might be thinking. Oh, great, here we go with the crypto hype. And that is a perfectly fair question for any serious investor. Abdu knew people would think this, and he addresses it directly. And his answer is an emphatic no. This has absolutely nothing to do with speculating on cryptocurrencies. It's all about efficiency. Think of the token as just a modern digital container for your traditional legal share in the LLC. It's using new technology to solve old problems like slow, expensive, paper-based transactions. It's an upgrade, not a gimmick. And this is where it all comes together. I love this slide because it shows that tokenization isn't some brand new, crazy idea. It's just the next logical step in an evolution that's been happening for decades. We went from slow, paper-heavy funds to the legal protection of an LLC, and now the token just a more efficient wrapper that unlocks the final piece of the puzzle, a potential secondary market. The ability to trade your real estate share like a stock, well, that's the holy grail. Okay, so this all sounds great, but what's the catch? As any good fiduciary will tell you, there is no free lunch in the world of investing. And true to form, Abadullah is incredibly upfront and honest about the trade-off you're making with this model. And here it is. Let's be very clear about this. By giving up that massive leverage you get from a bank loan, you are consciously choosing a lower potential upside. You're not trying to hit a 10x home run overnight. But look what you get in return. The risk of ruin, of being wiped out by a foreclosure, drops to zero, and you gain the potential for liquidity. That is a powerful exchange. And this final thought really just sums up the entire philosophy. You're trading a lottery ticket for a fortress. Are you a speculator using massive leverage to gamble on hitting the jackpot while risking everything? Or are you an investor, methodically building a stable fortress to protect and grow your wealth over the long term? That's the fundamental choice this thesis puts in front of you.